Nvidia, the largest, most valuable company in the world that's powering the AI revolution, and Cava, which makes Mediterranean bowls similar to those that you find in Chipotle Mexican Grill. Two companies that probably couldn't be any more different, yet today I'm going to cover both of them. Why? Because they're both stocks that I own, and they're both stocks that reported earnings during the past week. Now, if we look, we can see that both have done pretty well too. Over the last 6 months, Cava is up, believe it or not, 56%. And Nvidia, which just reported earnings yesterday, over the last month is up 11%. So we're going to spend the next couple of minutes trying to figure out what we learned about these companies and how to think about them moving forward. My name is Brian Stoffel. At the time of this recording, as I said, I own shares of both companies, and I want to give a shout out to Fiscal AI for sponsoring today's video. You're going to hear a whole bunch more from them as we go on. So let's start with Cava. Again, think of it as Chipotle Mexican Grill for Mediterranean food. This was the company's first quarter of 2026. They have a very weird calendar ending on April 19th, and it's about a $9 billion company. Excuse me. So when we look at revenue, it grew 32%. It beat analyst estimates by about $19 million. Management had guided for full year comparable stores growth of 3 to 5%. Now, again, what that means is we're not including new stores that have opened over the last year. We want to say apples to apples. How did sales compare at the stores that existed a year ago to the ones that exist today? For the full year, management had guided to about 4% growth, but during this quarter, it was way, way higher than this, coming in at almost 10%. So obviously that's beating what people were expecting. On the bottom line, earnings per share shrunk, but actually Wall Street was expecting them to do even worse. And then the guidance that management gives is restaurant level profit margin for the full year. They thought that it would come in at 23.9%. It actually came in at 25.1% during the quarter. Now, this is, of course, just one of 4 quarters, but still pretty good. Let's look at margins. When we do that, gross margin is so important when it comes to restaurants because it shows a restaurant's ability to maintain and show that they might have something that represents a moat. This is a very low moat business, but margins actually expanded. Now, 10 basis points or 0.1% expansion of gross margin might seem like a small deal, but it is definitely a solid number. And operating margins expanded even more. Net margins were down. You'll see why that's really a nothing burger in the long run. Cash flows and net incomes are very low on an absolute basis. Cash flows expanded meaningfully. Net income's about the same. But the bottom line, it's worth noting, is that this company is in solid financial position. They are free cash flow positive. They have no debt. They have $400 million in cash on their balance sheet. Now let's go down the income statement. So as I said, revenue up 32%. The cost of that revenue, in other words, what it costs the company to get its food, its beverages, the people to make things, the rent or occupancy that they have to pay, that was also up 32%. In general, not bad. You like to see revenue growing a little bit faster than the cost of revenue, but in this environment where inflation is still quite sticky, this is pretty good news. And management did say that since 2019, the company has actually been able to not pass on the same level of inflation to their customers. They're not going to discount, but they've been able to make it so that they don't have to pass on all of that. And what they said during the conference call was that they plan on making sure that they don't have to pass on, they will eat some of those cost increases. And that had analysts a little bit worried, but on the conference call, they said, look, we have seen in specific locations, and they called out one in California, where in the past inflation has been quite high, and yet they did not pass that cost inflation on to customers, and they more than made up the difference because more people came into the store because it was still affordable. This is the other part to like. Operating expenses was only up 26%. So when the operating expenses grow slower than revenue, what you get is this. Operating profits exploded 61%. That's great news. Now, there's a whole bunch of stuff that happened in between. A lot of it has to do with one-time tax things. So the only other thing I'll call out is the number of shares outstanding was up 0.7%. I yellow coded that because we'd love to see it stay the same or go down, but this isn't egregious dilution by any means. Now, it's always worth getting more information about what's going on. And if you are an individual investor, like I am myself, I couldn't get along without going to Fiscal AI every day. I think if you want to become a better individual investor, this is the place to do it. If you click on the top link below, you can go and use the site with free functionality. And if you get a full year subscription, you'll get 15% off using that link. So I've gone over and I've done a couple things, but look at when it comes to restaurants, there is nothing more important than same-store sales. That thing I just pointed out before. So I pulled out a couple of different things here, and I want to show you what we see here. So first, this is some of their peers. This is Sweet Green's same-store sales trajectory from the middle of 2024 to today. And you can see that for the last 5 quarters, same-store sales have been falling, down 13% in the most recent quarter. What about if we look at another company in the area? And this time we're going to look at Brinker. This is a company behind, say, Chili's. Now, what we saw here is that their same-store sales were exploding while they were falling at Sweet Green. Some of that is because they were low beforehand, but in the most recent quarter coming in at about 3.6% growth. So that's a tale of two very different companies. One thing I will note, however, is that in both cases, since the beginning of 2025, their same-store sales growth, that growth rate has been decelerating or going negative. Let's look at another company, this time Shake Shack. And what we see here is same thing. What we see is that same-store sales, actually not quite the same, they're the purple, is that they have been increasing over the last 4 quarters at muted numbers, coming in at about 4.6% growth in the most recent quarter. Next, the biggest player in the industry by far, which is Chipotle. Now, Chipotle is the green. They're in much the same territory that we see Shake Shack in, although they have gone negative over the last couple of quarters. In the most recent quarter, showing just 0.5 percentage point of same-store sales growth. And then finally, Cava. And this is what I want to call out. Cava's in the red. They have been doing better than pretty much everyone, minus Brinker, for most of this time. They have not gone negative over the last year and a half. And most importantly, they saw their same-store sales growth accelerate notably from about break even to a 10% growth. Now, some of that could be because the company introduced salmon and they've had more people coming in for that. But it's important to note, this did not increase because they increased prices alone. Traffic increased to 6.4%, and that accounts for the lion's share. So existing stores are simply becoming more popular. And the company said that the new stores that have opened within the last year are trending above average for how they're doing. What else happened during the quarter? The other thing I want to show is this. The company gives restaurant level profit margins, okay? Growth in restaurant level profit margins is the blue right here, and the orange is growth in revenue. Now, here's what you'd want to see because it would show that profit margins were growing. You'd want to see this blue line above the orange line. So when profits grow faster than revenue, that means your profit margins are expanding. Makes sense. So for a while, that's what was going on here. But starting in about mid last year, you see that they just came in just slightly below. And then over the last 2 quarters, profit margins have been crimped. They've been contracting. In the most recent quarter, they came back to break even, which is a great sign by and large. One last thing that I want to show, because this will become important in just a minute, are the number of stores. So you see down here in the orange are the number of stores that they've opened. And so far, in the last 2 quarters, they've opened 44 locations. That is 10% growth in their total number of locations. They've got 459 locations now. To put this in perspective, Chipotle is over 3,000. Now, Cava calls out that they believe that they can reach 1,000 locations by 2030. That means they will double their locations, in theory, by 2030. That's going to become important in just 1 minute. All right, so what did management say about moving forward? They upped the midpoint of their guidance for comparable store sales. They used to say midpoint will get 4% growth in comparable store sales. They're now at 5.5%. And it's worth noting that they said so far during the second quarter, which is going on right now, they've continued to expand same-store sales at the same pace as in Q1. So we're talking about almost 10% sales growth. So you might be saying, Well, why is it going to slow down as much? Now, some of this is just the company being conservative, but they did call out that energy prices are going to go up. And those energy prices affect shipping. And of course, they have to have their food shipped to them, and occupancy costs. It costs more money to run things. And they said what's happening in the Middle East is a big part of that. Analysts estimate that revenue will go up about 27%. So that's not an apples to apples comparison. Analysts estimate that earnings per share will be flat, but it's worth pointing out that management also upped ever so slightly the midpoint of their guidance for the full year of restaurant operating profit margin to about 24%. So as a shareholder myself, what am I going to watch moving forward? I hope I made it clear that the number one most important thing is comparable or same-store sales growth. That's number one. I want to see it over 5%. Number two are those restaurant-level operating margins. I want to see them over 24%. Number three is commentary on their expansion plans. And number four, I want this company to remain free cash flow positive. All right, so all that being said, the stock has done very well. What about its valuation? Great question. There's a couple different ways that we can look at this. And I think that we should use forward guidance, not backwards looking, because this is a company that's growing over 30% right now. So the first thing I pulled up was forward price to sales. And what you can see is it's trading for about 7 times price to sales. Now, that's pretty high on an absolute basis for a restaurant. It is worth pointing out that compared to the last couple of years, its averages at about 8. So in theory, you could say it's about 14% undervalued based on this. We can also take a look at its forward price to earnings. Now, it is worth pointing out this company is not optimized for earnings, and you can see that right here. It's trading for 159, 160 times forward earnings. That's super high on an absolute basis. But look, they're expanding their footprint, and of course, they're not optimized for profits. For what it's worth, it actually is underneath where it's been over the last couple of years, but that doesn't mean very much because these are really high numbers. I think that the best way to look at this is by doing a optimized reverse discounted cash flow analysis. Here's how we do that. First, we're going to put in the ticker symbol right here, Cava. Then we want to optimize those free cash flow margins. At its best, Chipotle had 13% free cash flow margins in its best years. Let's assume Cava can do that. 13% free cash flow margins. If they did have that, then their free cash flow right now would be $170 million. Now, look, they've got so much room to grow. So I would say even beyond 10 years, it's not unreasonable to say, look, this company could grow by 4% after the next 10 years for a while because they've got a lot of room to grow. So if we give them a 4% terminal discount rate, well, then revenue only needs to grow about 19-20%. If we let's give them a 3% terminal discount rate, then they need to grow at about 21%. So 21% growth. Let's call it 21% growth. That's what they need, revenue growth over the next 10 years to justify today's stock price. Well, what do we think of that? Can they grow 21% per year over the next 10 years to justify that stock price? I mean, they just grew at 32%, so that looks pretty good. But this is one of the great things about Fiscal. We can go in there and we can look at, well, what do analysts expect? What do they expect from this company moving forward? And look at, if you pay for their top level, you can get a look right here at expectations over the next couple of years. And so what I'm going to do here is I'm going to pull up their revenue growth rates on an annual basis. You can see that those revenue growth rates have re-accelerated recently, but most importantly, let's see how they're expected to go. They're expected to grow 27% this year, followed by 20%, but then 21% the year after that. I actually think there's an even better way to think about this. Look, they're sitting on 439 stores right now. 439 stores right now. Just to get from that up to 1,000 stores by 2030, they have to grow the total number of stores at a compounded rate of about 19%. Now, that's just over the next 5 years, not the next 10, but I think they could probably continue growing beyond 1,000. I mean, look at how many Chipotles there are. I don't think that's unreasonable. So if they just grow their stores by 19% per year between today and 2030, and they just have same-store sales of 1%, 1%. Well, then they hit that number. They hit that number. So that does not seem unreasonable to me at all. I actually think that this valuation is very reasonable given their growth trajectory. Now, of course, it's going to be a bumpy ride between now and then because there's a lot that can happen. You go through cycles. But that seems like a pretty reasonable price tag right now. So that is what I think of Cava. Now, let's move on then and talk about the big story this week, which was Nvidia. But before we do that, if you enjoy analysis like this, I think you would love to become a member of Stock Investing Mentor, my own investing program. Now, there's 3 parts to this. One is 1 hour of live weekly training sessions every week, Thursday, noon Eastern, recorded if you can't make it. Number 2, you get full access to my portfolio in real time with explanations for every move that I make within that portfolio. And number 3, access to a private online investing community 24/7. If you are interested in Stock Investing Mentor, that second link in the show notes below is where you can get a year-long membership at 10% off. So don't forget to check that out if you're interested. Okay, let's talk about Nvidia. They also have a weird calendar. They've got something weird going on, them in Cava, where their quarter ended on April 26th. This is a $5.4 trillion, that's with a T, trillion dollar company. Let's look at the headline numbers. Revenue grew 85%, which is bonkers. If outside of just Nvidia, no company has done this at this base ever, or even come close. That beat analyst estimates, that beat management's own guidance. Earnings per share was wildly skewed by investments and means nothing. So we really shouldn't even pay attention to it. What we should pay attention to is down here in the lower right-hand corner. Management guided for about $51 billion in operating income. Came in at $53.5 billion. So they beat those estimates as well. And that was significant growth as well. Look at the margins. Remember what I said? That one all the way on the right, net margin means nothing. There's no way they got 95% net margins. That was from their investments. But look at this. Gross margins went from 60 to 75%. Operating margins went from 50 to 65%. Those are crazy numbers as well. And I will talk about what they mean in just a minute. Free cash flow exploded, nearly doubled from 26 to almost $49 billion. Net income tripled from about $18 billion to $58 billion. Balance sheet is stellar. $81 billion in cash, less than $10 billion in debt. Let's go down the income statement. Revenue grew 85%. So they grew how much? They pulled in by 85%. So how much more did they have to pay for those chips that they're sending people? They only had to pay 18% more. That is pricing power, the likes of which you will never see. It is like Nvidia sells water and we are in the middle of the longest drought ever. That is the type of pricing power that they have. And that is why their gross profit exploded 129%. Now, their operating expenses did grow 52%. It's worth pointing out that almost all of that growth came from R&D, from their next generation chips. They shipped a ton of Blackwell during the quarter. They're going to start shipping at scale Vera in the third quarter. Those R&D dollars are going, they're going to a good place. And when those dynamics combine, you get operating income off of a base of $22 billion, expanding almost 150%. Again, that's a crazy number. Now, this is why you shouldn't pay any attention to net income, because it was wildly skewed by $16 billion increase in investments. Overall, that's why net income was up by so much. It's also worth noting that the number of diluted shares outstanding was down 1.1%. Now, a couple other things that are just kind of worth noting. The company did announce that it's going to reorganize how it lets people know about its different divisions. You'll see that in just a minute. They also announced that they're upping their quarterly dividend from 1 cent to 25 cents. So on a percentage point, huge increase. On a yield percent, not that big of a deal. They also announced they have, if I have my numbers right, they had $39 billion left on their share buybacks. They added another $80 billion, and they're promising to return half of free cash flow to shareholders. Overall, that means that they have the ability to buy back about $120 billion worth of shares outstanding. Unfortunately, $120 billion of shares outstanding, and I can't believe this is an actual fact, that's only about 2% of shares outstanding, which is just crazy. That's where we are with this valuation. What else happened during the quarter? Let's talk about that by heading back over to Fiscal AI. Now, here's the first thing I want to show you. The thing about the chip business is that it has largely been considered a commodity business where you're like, well, you could get your chips from one of these 5 different chip providers, and so they don't really have any moats. But the fact of the matter is 2 things are happening here. One, obviously, is that Nvidia is the leader in GPUs, or graphics processing units, which are key for the thinking that happens in the AI world. And they have the best technology, but they also have CUDA, which is the software that is used to write these programs, and that introduces a moat. And when those 2 things combine, you see this. Before, and by before, I mean if you go back to 2015, every $100 in sales when Nvidia handed over a chip, it had to pay 45 cents for that chip. So it kept 55 cents. And it continued to climb and climb and climb and climb. And you see that now, when it sells $100 worth of chips, it only had to pay $25 for that. And it gets to keep $75 as profit. That's a big deal. Now, while it's not as high as it was at its absolute highest in the middle of 2024, as long as these gross margins remain above 70%, it tells you that the company still has pricing power. And that is a key signal. The other thing I want to point out is just the revenue growth rates in general. Now, this is typically a very, very cyclical industry. I'm going to pull this all the way back, and that should become obvious. You see, starting in 2016, we have boom times and then bust times. Boom times and then bust times. Boom times, but this time, the bust times, all that meant was that revenue was growing only 55%. That's a pretty good bust times. And look, we are back towards the boom times where revenue growth is re-accelerating. That is very impressive. And it's expected to continue accelerating. Now, as I said, the company also decided to disaggregate how they report. And it's really just in 2 sections. The first is data center revenue. And within this, and this will probably show up in fiscal pretty soon, they will differentiate between what they call ACIE, which is AI purpose-built data centers, chips going to those AI purpose-built data centers, and then the hyperscalers, so they'll break out the green. And then down here is what they're just calling edge computing, which basically just means when the chips are on the devices that are at the very, like the phones and the robotics and things like that. So it's just worth noting that the data center revenue continues to accelerate. And that's no surprise. We just saw the revenue numbers, and this is the primary component of it. It was up 92% during the quarter. But it is worth checking in with the edge, because the edge is going to be a bigger part of it, especially when it comes to robotics. The revenue growth rate there, not quite what it was before, but still growing 29-30% overall. What else just happened during the quarter? The other thing that I think is really worth mentioning is the company spent a bunch of time talking about how they believe that their demand in CPUs, is going to be taking market share. Now, GPUs take care of the thinking. CPUs take care of coordinating in an AI world. And when it comes to simulation, it can be a combination of the two. But the bottom line is they really believe that their Vera, which is going to be shipping at scale in the second half of the year, is going to be capturing a lot of CPU market share, which is important because a lot of people thought that we might be tapering off on the GPU growth. And they're saying, look, we can dominate both GPUs and CPUs. And that's a pretty big deal. They said that their standalone Vera CPUs are expected to be about a $20 billion business. Of course, that's a small part, but them making progress in here is really important. So, of course, then the question then again becomes, what about the valuation? Before we get to that, it is worth pointing out what things look like moving forward. Management guided for 95% growth in the second quarter, which is above analyst estimates. They are projecting for operating income to more than double. I wouldn't pay too much attention to analysts' earnings per share estimates because that investment income is so volatile. The bottom line is they expect operating income to more than double. What am I going to be watching as a shareholder myself? Well, first are those Vera sales. We won't get clear numbers on that until the second half of the year. After that, the revenue guidance for the third quarter, because things change very quickly in this area. And so that guidance really does give you some visibility as to what's happening. Number three, because I really pointed out those gross margins, they're expected to be about 75%. My goal, my hope is that over the long run, they can stay above 70%. And number four are those capital returns. Look, the company is so highly valued that we don't feel those capital returns as much, but over time, they can make a difference. In my opinion, there is no question that the moat is stable or widening around the company, even with all the competition entering, and that the thesis is very much on track. So now let's look at the valuation. First thing we can look at is the company's, and I'm going to look at this on a forward basis, their forward PE. And when you look at this, we've got a company that's expected to basically double revenue and double profits. Double revenue and double profits in the next quarter. And it's only trading for 23 times forward earnings, which is very reasonable on an absolute basis. And oh, by the way, is at about a 40 to 50% discount from their long-term average. Or we could look at it on a free cash flow basis. Right now, they're trading for about 24 times forward free cash flow. And their long-term average is 36. So again, about a 50% discount. Now, of course, the reason for that is they have such a huge base. And so there's this thought that how fast could they really grow? The other part of this is there is lots of competition coming. Look, Broadcom is developing lots of chips with lots of different companies because they don't want to be beholden to just Nvidia. And I get it, but I think that the demand is so big, it might be okay. Like it might not be that big of a difference. Let's do the same thing with Nvidia that we did with Cava, which this time, though, we're going to do something different, okay? Nvidia right now is approaching 50% free cash flow margins. I want to be prudent. I want to build in a margin of safety. So instead of thinking that they'll expand, which I think is not prudent, or thinking that they'll stay the same, which could happen, but to me is not proven, let's pull it down. Let's say that they fall to, I don't know, about 37% free cash flow margins, which is notably lower than they are right now. So I'm gonna penalize them because I don't think that they can be this profitable moving forward, but that gives me a margin of safety. So if we assume that, then they would have about $95 billion in free cash flow. It's actually higher than that. We'll give them a 3% terminal growth rate, a normal discount rate. So then how fast do they need to grow moving forward? Well, look at this. It's the same number as it was with Cava, 21%. So Nvidia needs to grow 21%. What do we think of that number? Okay, what do we think that they can accomplish that moving forward? Remember, that's for 10 years too. Well, let's pull up where revenue growth is right now. We can see that it's growing at 70% over the last 12 months. It's expected to grow 95% next quarter. That's way higher than 21%, but this is typically, not always, but typically a very cyclical industry. So here's what analysts expect. They do believe that it'll grow 73% this year, but then that'll fall to 34 and then 22. If it falls that much, and it continues on that trend downwards, then you can see why that this valuation might look a little bit stretched. So you would say that, look, if by 2030 it's growing at less than 21%, then I don't know how comfortable I feel about these assumptions. It is worth pointing out, however, that these estimates have been really wrong for quite some time. And if you don't believe me, look at this. When analysts started guessing how much money the company would make in 2025, they said, I bet it'll be about $36 billion. Let me say that again. When analysts started guessing how much the company would make in 2025, they said about $36 billion. They were off by an order of magnitude. It came in at $130 billion. How about this year? When they started guessing, they said, the company will make about $109 billion. Right now they're saying, sorry, we were off by the factor of 2. It's going to be $213 billion. What about next year? It's already been revised up from $240 billion to now $381. What about 2028? When we started off, we said this is we're approaching $500 billion, $416 billion. Now they're saying it'll be over $500 billion, $506 billion in sales. The bottom line is that there's a pretty good chance, it's not guaranteed, but a pretty good chance these numbers will be notably higher. So I would say that at worst, it's a fair valuation today. So those were my thoughts on Cava and Nvidia. If you want to keep up on this, don't forget to hit subscribe. But just as important, I want to know, what did you think about the earnings for these two companies? Let me know in the comments section below. And if you'd like to join Stock Investing Mentor, don't forget, second link in the show notes below. Until next time, Brian, out.